Why do you think dealer fees have increased so much over the past 5 or 6 years?
I think that this creates an opportunity for bank lenders to get into this space, or who are in this space already, to really scale their businesses over the next few years.
This to me is sounding like the subprime mortgage crisis all over again.
If we have less solar being developed, that's going to create an imbalance between energy supply and energy demand. We are very hopeful that there's, a change in legislation in the future that gets us back on track.
All right, welcome back to the Solar Surge podcast. Hey, if you're new to the Solar Surge podcast, on this program, we meet with the top CEOs and the top thought leaders in the solar and energy storage space. Now, this morning, I'm joined by Chris Cucci, who's the Executive Vice President and Chief Strategy Officer at Climate First Bank. It's one of our preferred solar financing partners. And we're going to be talking about all that's been going on, particularly in the solar financing sector, in light of everything that has just happened with tariffs and tax credits and just everything that's going on. So, Chris, it's really good to meet you. Thank you for joining us this morning.
Thanks, Joe. It's good to be here today with you.
Excellent, excellent. Well, Chris, as you know, there's a major shakeup going on in the solar industry, particularly in the residential sector of the solar industry, and particularly as it pertains to financing of rooftop or home solar power installations. I think the last major event that we covered in this space was Mosaic's bankruptcy, which I know you are all aware of. But I'd like to get your take, big picture, on what is the current state of solar financing, and how do you think the industry is going to be affected by the passage of this so-called big beautiful bill?
Yeah. So I think obviously we're still waiting to see exactly how this all plays out. But first thing that I think we all know for sure is this reduction in the solar tax credits, or elimination, impending here. Uh, it's going to just vastly reduce the adoption of solar for consumers across America. It's something we don't want to see, obviously, not just from a business standpoint, but I think more heavily for us from a mission standpoint, from our values. We started this bank with the vision that we wanted to see solar on every rooftop in America, and we want to be a part of that story. But we know that it takes many lenders, many financing solutions to meet the needs of all the demand across the country. So, very worrisome time, not the outcome that we were hoping for. I think we were also expecting that the bill, once it passed through House, the first go around, that we thought there would be um, some moderation in Senate, and initially there was, right, and then towards the end, it kind of swung back the other way, unfortunately. And I touch both sides of the business, the consumer solar, and then I work a lot directly on our commercial solar side as well. Forecasts right now are pretty grim for both sectors, but more immediately for consumer.
Yeah, no, it's going to be a tough time out there now, and definitely need to make some adjustments. Let's talk a little bit more specifically about what's going on in the finance sector, because I understand there's a lot coming unraveled. Now, a couple of weeks ago, of course, Mosaic declared bankruptcy. Mosaic is probably one of the most well-known solar finance companies. Late last week, the Wall Street Journal put out an article entitled "The Wall Street Engine for Financing Rooftop Solar is Grinding to a Halt." Chris, can you tell us a little bit about how does the solar financing business model work, and what's different between a solar financing company and a traditional direct bank lender?
Sure. So, and first of all, very disappointed, and feel for the leadership at Mosaic, and also for those employees who are out of work, and for all of the installers and homeowners who will be impacted by that. One of the pioneers, obviously, in the industry, and really, I think, invented the roadmap for a lot of the work that's been done over the last decade or so in consumer solar. The so let's talk about like that model, Mosaic, GoodLeap, some of the other non-bank lenders that are in the space, and how they work. They are originating those loans on the front end, but they don't have a balance sheet per se where they're holding those loans long term. This is obviously what 15, 20, 25 year loan term. So it's somebody has to be a very patient investor with a lot of liquidity to be able to fund all of those loans, these billions of dollars in loans that are being originated every year. The way that that's done is through something called an ABS, or an asset-based securitization. Um, this is where a lender or an originator, so like Mosaic, for example, will originate millions, hundreds of millions of dollars of consumer solar loans across the country. And those loans are typically in various tranches within that portfolio. And what I mean by that is there's different kind of bands of quality in that portfolio. Some 10-year loans, 15-year, 20-year loans, 25-year loans, and then varying credit scores. There might be some really prime grade credit scores in some bands of that securitization, and there may be some less strong, weaker credit scores or higher debt to income ratio loans that are in that pool as well. The thought process with this is that, you're kind of spreading the risk. You're mixing these different types of loans. Obviously, the typically higher risk loans with lower credit scores, it's a little bit of a higher return. There's going to be different interest rate tiers and things like that. So, as an investor, as a buyer of that asset-based securitization, you're looking to get an investment that balances risk and reward. Who's buying that? Those ABS securitizations, institutional investors. So sometimes it's actually banks and credit unions. A lot of the ABS issuances that Mosaic and Goodleap and others have done over the years, those have been bought by community banks, credit unions who wanted to participate in solar lending, but didn't maybe have the expertise to do those originations up front. So you have people like that. You also have organizations on Wall Street, investment banks that are buying that paper, maybe some, impact funds and things like that. So constantly need this cycle of our new originations by the lender, packaging and securitizing those loans, and then those securitizations being bought by the, let's say, by Wall Street. When they stop buying, the lender no longer has the ability to originate at the same velocity, or maybe can't originate at all because they don't have a buyer for the loans.
Right, right. Okay. Well, thank you for explaining that, because I think that's a misconception. So they need to be able to borrow new money and securitize those loans and sell those loans to investors. So how does a traditional or a direct bank lender like Climate First work in comparison?
Great. Yeah. So, as a bank or a direct lender, we're actually holding those loans on our balance sheet. Um, how are we able to do that? Well, we are taking in deposits from customers. We are a full service bank, so we have people opening bank accounts, and that provides us with liquidity to fund loans. The other thing we need to have is capital. Capital as a bank is like, think of it as how much money the bank has in their bank account, right? We have an account somewhere. That capital that we have has to be at a certain level for us to continue lending. And these are not perfect numbers because there's some nuances to it, but I think the simple way to understand it is this. We need one-to-one liquidity. So if we're going to issue $100 million in loans, we need $100 million in deposits. And then typically think of it as a roughly 10-to-1 on capital. So if we have $10 million in capital, that will allow us to leverage for $100 million of loans. So the capital and liquidity are the two things that we need to continue to originate loans. We hold those loans on our balance sheet at the bank, and you think, why would we hold a 30-year consumer solar loan on our balance sheet? Well, we know that most of the time, the average life of those loans is only about 7.5 to 8 years for a variety of reasons. People choose to pay them off early because they have the money to do so. People refinance their homes, and when they refinance their home, they get a lower interest rate on their home loan. They're able to pay off the solar loan with something that maybe is at a more favorable rate. Or somebody moves. People move, on average somewhere within every 10 years, across America. So when that happens, you sell your home, you pay off your solar loan. Knowing that average life of the loan is slightly less than 10 years, we're willing to put those loans on our books, hold them, with the theory in place, which is a pretty safe theory based on history, that most of those loans will pay off over the first decade. There's only a few remaining that will hold long term.
Makes sense. Makes sense. Yeah. What is it? Like the average homeowner will move or sell their home every 7 or 8 years. Is that right? And so
That's right.
typically that's when these things get settled out.
That's right. And one of the things that I think about where we are today and looking at some of the maybe some of these portfolios not paying off quite as quickly as we've seen historically is that we're in a little bit of an odd time because interest rates have gone up a lot and people got really low mortgage rates uh, if they refinanced or bought a home, I don't know, 5 years ago, right? Those rates that they got 5 years ago. I bought a house in 2019. It was 3.5%, 4% mortgage. I'd like to move right now. I've been looking for houses. At the same time, it's like, man, I really don't want to give up that low interest rate. So it's slowing that decision for people, which means these loans are staying on the books a little bit longer right now, but still, it's not always a decision we make. Life happens, job change, people move for family reasons. So I think we'll still continue to see about, somewhere sub 10 years on average for people moving.
Sounds good. Sounds good. All right. Well, let's go back to the issue of these securitized solar loans because I think there's some misconception here. I remember when I got started in solar finance, I started meeting with solar financing providers, and they were saying that the default rates on solar loans were lower than just about any other type of consumer lending. It was about a 0.5% default rate at the time. This was going back to 2017, 2018. But according to that Wall Street Journal article, default rates are going through the roof now, and some of these bondholders are no longer receiving their interest payments. Now, my understanding is that a big reason that a lot of these homeowners are stopping making payments on the solar loans is because the solar system just isn't working, and the contractor has gone out of business, so nobody is coming back to repair the system so that the system is doing what it's supposed to do and saving them money on their electric bill. So, Chris, what's your take on what's causing the surging defaults in consumer solar loans, and where do you see that going in the future?
Yeah, I think it's a combination. I certainly think that what you mentioned is in play. We have had some solar installers, some EPCs that have gone out of business, shut down over the last couple of years, definitely accelerating. Um, and so that's certainly impacting these borrowers and their willingness to repay. I think the other thing to consider, though, is that we have seen a significant um, increase in the velocity of origination. So the number of consumer solar loans being originated over the last 3 years compared to the prior seven, if we go back a decade, it's more than double, I believe. Year over year, it's really grown a lot. Um, Two things happen with that. One is you had a lot of newcomers to the game, new EPCs, new installers who came in. Um, the failure rate of businesses typically extremely high in the first 3 to 5 years that a new business opens. Once they get past that 3 year mark, typically their survival rate is a lot stronger, but the potential to go out of business within the first 3 years is much higher. So you have those newcomers, more of them coming in, a lot more loans being originated or more new systems being sold, which is a big risk. The other thing we had this really favorable environment because of the investment tax credit, the solar tax credit that everyone was taking advantage of. Um, a challenge with that is a couple of things. One, I think, would be sometimes a lack of understanding how a tax credit works for the salespeople who are positioning it, and also for the consumer who is buying solar. People sometimes view it as a rebate instead of viewing it as a tax credit. You do need tax liability to be able to fully monetize that credit. Um, a lot of these solar loans are structured in a way that the payment is a reduced payment for the first 18 months. And then the theory is that you're going to use your tax credit to reduce the balance before month 18, at which point everything will level out and you'll be able to maintain that low payment for the duration of the loan. If you can't monetize the tax credit fully, or if you can't at all, that payment spikes up. So that's the other challenge that can occur, is that a consumer goes into this maybe not buying as fully informed as they should be, or maybe they weren't well informed by a sales rep, and then this payment spikes on them, and now they're facing a much higher payment than they expected, and they think, well, I'll just go back to paying a power bill at this point because they're looking at it as a comparison between the two.
Yeah, that's I think one of the big criticisms of these solar finance companies is they offer these introductory low monthly payments or these promotional low monthly payments for 12 or 18 months based on the assumption that the homeowner is going to capture and apply a tax credit to pay down the loan to keep that monthly payment. But Chris, what I'm told is that only about 20 or 25% of borrowers actually make that pay down within the grace period. The other 75% or 80% end up jumping up to the higher payment.
Yeah, that's right. And in fact, we see that we don't actually do the escalated payments with our product, but we also we see the same thing. It's a small percentage of our borrowers who actually when they receive the tax credit, use it to pay down our loan. And there's some cases where they get the credit, they get that fund back, and they opt to use it for other things. Because if you have a solar loan at 6%, 8%, whatever it is, you get a $12,000 check for a tax credit back. You might use it to pay off a credit card or something at a higher interest rate, which is smart. But it's something people have to really factor into this decision when they're making it.
Yeah, yeah. Now, of course, the other issue is this issue of dealer fees and why these solar finance companies, the ones that you described earlier, where they have to borrow money, they package the loans, and then they sell these loans to investors. Why is it that you feel that these companies have to charge dealer fees, and why do you think dealer fees have increased so much over the past 5 or 6 years?
Yeah, so this is another challenge, you're right? The if you look at the non-bank lenders in the solar space, one thing you'll notice immediately as a consumer pricing your different options is that their rates are going to look a lot lower, and they are. The interest rate that they're charging is lower because of that dealer fee. So the rate may say 5.99% for 20 years. On the back end, there's a 30% dealer fee or whatever. Why does that exist? Well, it exists because they're charging that low face value rate to the consumer, and Wall Street's not going to buy a 5.99 consumer solar paper. It's what we call a loan. We say paper in the industry. So they're not going to buy that paper at a 5.99 rate that's secured by some solar equipment on someone's roof. That's not enough reward for the risk that they're taking. So to um, account for that risk, they have to pay up, to be able to sell those loans to these third-party investors through the securitizations. And the way that they accomplish that is by building in these dealer fees. So consumer gets what looks like a good rate. I think it's always important to focus on payment versus rate for exactly this reason, because the payment really tells the true story. But the consumer is getting a good interest rate, which attracts them. When they're looking at just rates on the screen, they think they're comparing apples to apples, and sometimes they aren't. They make that decision based on that rate. And then on the back end, the ABS securitization is happening. It's being sold. That premium is being attached to it because of the dealer fee that's being charged. And that's what creates this disparity between the rate that they see and what they're actually coming out of pocket with every month on the loan payment.
Okay, Chris, so if I'm understanding you correctly, then part of that dealer fee that is retained by the non-bank lender is used to pay as a premium to the investors that they're selling these loans off to. So it's kind of like some additional interest that the investor would receive on top of whatever the top line interest rate that was presented to the homeowner.
Basically, I mean, the best way to describe it, I would say, because I think everybody has bought, a lot of people have bought a home before or understand how mortgages work across the country. So it's just like when you get a mortgage loan, sometimes they'll ask you, would you like to buy down the rate? And you can pay points to buy down the rate.
Hmm.
Think
Yep.
of a dealer fee as a really, really big buy down on the rate. So it's, instead of being 2 or 3 points that you pay on a mortgage to get your rate down 1%, you're paying 30 points to get your rate down a couple of percent. And that's really what's happening. And yes, that benefit of that is being ultimately um, passed over to the investor. And it's just to and continue to make those loans sellable. That's right.
Now, Chris, there are some critics of the industry that would say that the reason why these dealer fees are so high and why the sales reps and the contractors are incentivized to choose loans with higher dealer fees and artificially low interest rates is very simply so that the customer does not have an incentive to go and shop for other lending options. They're incentivized to go ahead and sign up right away while the sales rep is in their home on their tablet offering a below market interest rate loan, but in many cases, it was not disclosed to them that they're paying 30% higher or 40% higher purchase price to get that below market rate loan. What would you say to those critics?
Yeah, no, I mean, I think that's one of the problems that damages our industry. The and I don't like to like paint with broad strokes with this stuff. I think in general, we deal with a lot of solar installers, EPCs. We deal with sales organizations all the time at the bank. Um, the vast majority of people we deal with, they want to do what's right for their customer. They want to be honest, forthcoming with people about the benefits and the drawbacks of various types of financing options that they have. Where I think it gets to be a little bit of a sticky situation, something that people have to really look at and say, is this the right system and is this the right thing for consumers in America? Is that there really isn't a clear regulation being enforced today to make that pricing decision more transparent for a consumer. So, you know, uh, I believe in buyer beware, of course. I think the buyer really does need to do their homework, but it's really hard. When they see an interest rate and they're just comparing two rates, it's hard for them to understand that there's a fee in the background, especially when in a lot of cases the installers are not allowed to disclose the existence of that fee to the consumer. And this is why we try to do educational campaigns for people through blogs and through op-eds and things like that at the bank through our marketing and public relations of talking to the market in that way and saying, hey, just don't just look at the rate, look at the actual total cost of the system. Ask a question: if the system cash price is different than the finance price, why is that? Start to peel it back a little bit. Because yeah, I mean, I think that is a problem with our industry, and it's something that does have to go away.
Yeah. I think, I mean, Chris, the way I'm looking at this to me is sounding like the subprime mortgage crisis all over again. And I know that legally, a lot of the way that these loan agreements are written up, legally, the loan company or the non-bank lender that you mentioned, they're not necessarily liable to provide long-term system maintenance. But from what I'm hearing from homeowners, and I see comments on the YouTube all the time, well, I'm not going to make any more payments unless they send somebody out here to fix the system. And if these non-bank lenders need a constant flow of investors to buy their tranches of loans, if those borrowers default, that non-bank lender can't continue to sell these loans to the investors. Chris, am I reading that properly? And what's your take on that?
Yeah, no, I think so. It's creating a liquidity crunch right now in the market. The capital markets for these solar ABSs seems to be drying up. I think it will be interesting to see over the next few months, because typically about towards the end of each quarter, we start to see reports coming out that tell us what securitizations were issued and how they performed from prior quarters. Obviously, as you know from the Wall Street Journal article and some of the other stuff coming out recently, it's all been bad news. Um, I think the other thing too, though, is you have to really kind of peel back the curtain and look at those securitizations, those portfolios on a basis of how one compares to another. The one that we were talking about in the Wall Street Journal, which was a Good Leap that they had reviewed, that was a portfolio of fairly recent loans. The maturity on it was 2049. So you're talking about, if you're thinking 25 year loans, those are loans that were just issued in the last couple of years. Had 6.3% cumulative losses so far, which is well above which is that 0.7, 0.5% figure that you shared earlier. At the same time, I think one killer there, obviously, there's what we've talked about with installers going out of business, a lack of service for the systems that need repairs and maintenance. But you also have issues with the payment increase situation, with that payment increase coming in at month 18. Um, the average FICOs and debt to income ratios that you see on these portfolios is something else that I'm curious to say. I'm trying to get more info on the exact pools that they were referring to in that article. But what I would suspect is that you're going to see that, average FICO scores across that pool are probably sub 700 and maybe even like sub 680 on average. That makes a difference. We're also getting to a point where consumer costs have continued to go up. Wages have stayed pretty flat for people over the last few years. Um, so that impacts consumer credit in general. And for all we know, this could be the bellwether to other consumer credit issues that start occurring, more broadly beyond just solar.
Yeah, absolutely. I mean, if you look at just sort of the main business news headlines, they're talking about wages are basically flat or even down when adjusted for inflation. You got AI replacing a lot of the administrative and soft jobs that are out there. I believe the Wall Street Journal article, referenced a particular borrower who earned about a $45,000 a year income, and as such, she qualified for very little or no tax credit. And so her monthly payment after that promotional period, her monthly payment jumped from, I believe, $150 a month to $210 a month. And if you're making $45,000 a year and paying taxes and housing and groceries, there's not a whole lot of extra wiggle room in your budget to absorb a 40% increase in your power bill. And I just wonder, Chris, how many thousands or tens of thousands or hundreds of thousands of other borrowers are out there like that? That I believe in the article she said she shouldn't even have been approved for the loan. It was very very on the margin, and she really would have had to have that tax credit applied to make the solar investment make any kind of sense at all.
That's right. Yeah, I fear that there's going to be a lot more stories like that to come. And we've heard those over the years, but I think we're going to hear a lot more now. And this is where I hope we start to see more lenders across the board just underwrite to the full payment. I mean, they're going to have to beginning January, right? But start now. I mean, if you're looking at this stuff, you should be underwriting based on the full payment, not with any assumption of a tax credit. If the consumer does get the tax credit and they're able to make a principal reduction on the loan, great. That's accretive. That's icing on the cake. It makes the payment even lower for them. But we should really be looking at that full 100% financing payment without any kind of credits or reductions to ensure that they have some cushion to be able to service the debt.
Sounds good to me. Now, in the event that these loans do go into default, because I know that they use this term ABS or asset-backed security, but Chris, let's talk about the actual collateral that's backing some of these solar bonds.
Yeah.
Now, my understanding is, because I was in the industry, I was a contractor for many years, and we offered financing to some of our customers. We offered that option. Not once did we have to go out and repossess a solar system because a borrower stopped making payments.
Yeah.
But I could say that if I did have to, let's say I could take back some of the solar panels. Maybe I could take back microinverters or an inverter if it was mounted externally to the home, and I was willing to take the risk that the homeowner wouldn't come out there and start taking shots at the crew. But what of the collateral is really recoverable in the event a solar loan goes into default? And are these truly asset-backed securities the way a house loan or an auto loan would be?
Good question. So just I will make a distinction really quick, and then I'll talk about the broader comment you made. But when they refer to it as an asset-based securitization, the actual asset that they're referring to is just the loan. So they're saying this
Okay.
securitization is a pool of loans. They're referring to the loans themselves as the assets. And I know in our
Okay.
minds we probably think about the solar equipment as the asset. That is the collateral for the loan. And I think that's what you're referring to, when you talk about, going out and taking back the panels and stuff. And again, I would liken that to the mortgage crisis. The banks lenders in the mortgage space did not do well by repossessing homes. And that's why during that time, right, there was of course, a lot of legislation that was put into place to support this for the lenders. But they did what they could to keep people in their homes or to work out different ways that a person could get out of a mortgage without going through the process of foreclosure and actually repossessing the home, because that economically doesn't really make sense for the lender, and it's of course traumatizing for the borrower. So I hope it doesn't have to get to that point, and I think that's one of the reasons that it does behoove the lenders to try and work with borrowers and find other ways to manage through this. But what we might want to talk about is specifically, since you brought up the question of the ABS and defaults happening in those securitizations, how that works, because I think there's some other things that we might want to touch on there, if that's okay.
Well, yeah, please educate me and our audience. How does that work? And thank you, by the way, for clarifying that the asset in asset-backed security refers to the note, not the collateral. So the solar panels in this case would be the collateral. But as you say, it would be a marginal recovery, if at all.
That's
So the
right.
investor's really not going to get anything. The investor's really not going to get anything out of a solar panel repossession. I guess they just have to wait until the homeowner sells the home and try to enforce the lien. But what's your take on it? Please, let's
That's right. Yeah, and
take it
that's
away.
yeah, I think that's absolutely the outcome you see in a lot of cases. Um, but what I did want to mention, because we were talking about loans inside of this pool, like a securitization pool that start experiencing higher levels of default and non-payment. In a lot of cases, and again, I have to caveat this and say I haven't dug into the specific portfolio, the pool that was referenced in that WSJ article. But in general, there's typically credit enhancements that are provided on these securitizations. And that means that the lender, so, us, Mosaic, whoever's issuing this securitization, um, you're going to provide some assurances to that buyer, to that investor, that if loans are going into default for any reason, you have some backstops for them. There's different ways you do this. Sometimes you have what's called a loan loss reserve. So as the issuer, in this case, Goodleap, potentially could provide a loan loss reserve that covers the first 5% of losses on anything in that 100 million, $200 million portfolio. And generally, that's really good, right? If you're talking about the average default rate being sub 0.7%, if they're going to reserve, this 5% reserve for the first 10 years or 7 years on a securitization, that makes the investor, the buyer, feel pretty good about that portfolio, like they have some cushion there. Um, there's also instances sometimes where there's an agreement to swap loans out. So if there's a non-performing loan in the portfolio, you will take that loan back as the issuer and you'll replace it with a clean loan, with a new loan that is performing. Um, that becomes harder to do when you're in this instance, this situation we're in right now, though, where the level of interest in new securitizations is slowing down, because you do have to, again, continue to recycle capital. And that's the name of the game for the non-bank lenders, is they need that ability to constantly recycle their capital so that they can bring in new money, issue the short-term loans to get those solar systems originated, and then sell those as quickly as possible to recap all that money so that they can start using it again for new ones.
Makes sense. Makes sense. So, do you think that this puts traditional FDIC insured direct lenders like Climate First in a more competitive position versus the non-bank lenders compared to, let's say, where we were 2 or 3 years ago?
Yeah, I think and I was talking to someone internally about this recently, because right now I think that, like, a lender like Climate First or other bank lenders that are in the space, number one, w- any of us, I'll definitely paint with a broad stroke here and say any of us has a minuscule market share compared to the non-bank lenders that we've been talking about, who have dominated this space for a long time. So while we might see a, 50, 60, 70% decrease in solar adoption because of the absence of tax credits after the end of this year, I don't know that that necessarily adversely impacts our volume, because we're also seeing competitors leave the market right now or be forced out of the market. Um, so, if our sub 1% market share could turn into 2%, and that means we're doubling, tripling our business. Uh, we're successful right now for all the wrong reasons. This is not, we wanted to grow our market share as a lender. We did not want to grow it this way. We didn't want to grow it by seeing competitors fail. We didn't want it to grow it because there was a, sunset on the tax credit, which we think is one of the most important things that have been passed and extended by the last administration. So, um, yes, I think that this creates an opportunity for bank lenders to get into this space, or who are in this space already, to really scale their businesses over the next few years. And hopefully in doing that, do it the right way and make sure that they put out products that are very consumer centric, that are easy to understand, um, and that treat the installers fairly, give them the information that they need to be able to be successful and to present these solutions to their customers. So, um, if, in any in any crisis that occurs, there is usually some silver lining that you have to look at, and that's what I think we could see here, is that hopefully there's a bit of a tide that turns and we start to see a reinvention of the solar lending landscape for consumers into something that is more consumer focused.
Yeah, definitely. I think we need something that's more consumer focused. Chris, as we're recording this right now, there are over there are over 2,000 lawsuits pending from homeowners against solar finance companies like GoodLeap and Mosaic, these non-bank lenders, where essentially the homeowners are saying, like, I have a loan on my house, I'm getting monthly payments for my solar system. The system never got installed, or got installed but was never turned on. It's not saving me money on my electric bill. And the contractor who did the original installation has gone out of business. So they're seeking to have these loans canceled and the liens removed. Um, what effect do you think that has, and do you think companies like GoodLeap and others can absorb that much volume of lawsuits, or those loans potentially being canceled?
Yeah, I don't, I just, out of again, ignorance to exactly what's going on financially for some of those companies, I would say I don't want to comment with any certainty on what they can or can't absorb in terms of lawsuits, but um, thousands of lawsuits is never good, not just from consumers, but as you probably know, there's state attorney generals in certain states who have also started doing investigations into the lending practices, from some of these companies, and starting to really dig into that from a consumer experience standpoint and say, are things being done here that are on the up and up, for making sure that consumers are informed, that they're being sold what they think they're being sold, not just with loans, but also with TPO, with leases, and PPA as well. I think there's been a lot of lawsuits around that, and we've seen a lot of stuff that's really concerning to us. Even as we talk to consumers around the country. Uh, I think that's something that unfortunately I think we're going to probably see more of, um, and it's timing isn't good for those lenders to be facing those kinds of lawsuits, but that's probably, I would think, going to increase as well, along with along with everything else that's going on just broadly in the market.
Yeah, well, I know we're getting close to the top of the hour here, but let's talk about TPO for a little bit, because we also saw a couple of high-profile bankruptcies in the TPO space, namely Sonova,
Yeah.
also SunPower. Late last year, SunPower had a big sort of TPO segment as far as how they structured the financing on their systems. What do you think is going to be the short-term impact to the TPO space, and where do you see that going forward?
Yeah, I mean, the legislation obviously hurt TPO considerably as well. Um, and then the executive order that came out, it impacts heavily commercial, but the executive order that came out the Monday after the bill passed, which really limited the safe harboring opportunities, that really created a even faster sunset for commercial, which is mostly TPO, and then obviously there's an impact on the residential TPO side as well. Um, I think that legislation was probably the biggest blow. At the same time, we, as a company, were never big fans of the TPO model on residential, solely because we just hadn't seen very many models that worked in a way that we thought was fair to the consumer over the long term. And there were a few. There's certainly some exceptions. There were some companies we really admired in the space. Um, but for the most part, we would always consider it. We would look at some of the agreements when we talked to developers who were trying to, sell portfolios of residential solar leases, for example, and the controls on them, the escalations, and then also just you always question the stability of the providers who are providing that O&M, the operation and maintenance contracts. And you mentioned this earlier for the loan side. It's important on the loan side, but it's imperative on the TPO side that you have O&M contractors in place that have longevity and stability and that are going to be there for the duration of that lease term. These are 20 and 25-year agreements typically. Um, that's something that's really troubling to me right now. And so outside of legislation, which I think is the biggest impact to the space, the second biggest in my mind is questions around stability for the installers and EPCs, because a lot of those companies are the ones that are providing that O&M service on the TPO portfolios. And as they go away, finding other companies to replace them and at the cost that makes it sense is going to be a big challenge.
Yeah, I think so. Well, time will tell. I hope that there are some TPO companies that are able to put things together in a way that is successful long term. But after seeing Sonova and SunPower go down, it leaves me wondering, of the ones that are still operating today, will they be able to remain long term?
Yeah.
I guess time will tell. Well, Chris, I know we're getting close to the end of the interview here. I will leave it open to you. Is there anything else that the audience should know about what's going on with solar financing, or anything that's going on with Climate First Bank in particular?
Um, I would just say that we're Climate First Bank. We're open for business. We're still doing deals every day. We have a network of installers across the country, and it's still. Here's what I think is going to happen. Just people should really think about this. Um, if we have less solar being developed, commercial solar especially, across the country, because the tax benefits of it are going away, that's going to create an imbalance between energy supply and energy demand. We can't replace, and every report has shown this, we can't replace with solely, coal and legacy energy and keep up with demand. This did need to be a multi-faceted approach, and we need solar, we need wind, we need everything to be able to accommodate the energy demand. If that supply and demand imbalance continues for some time, which it will, utility cost is going to go up. It's already going up every year. You look at your power bill, your costs increase annually. They're going to increase at a higher rate more rapidly. As that happens, we will get to a point, I think, at some point. Also, the costs of panels, the cost of the equipment continues to go down. Hopefully, will continue. That also is up for grabs right now, for sure. But those things will get us to a point where we don't need the tax credit. At some point you have this equilibrium where the price of solar from your utility, or price of power from your utility, justifies the cost of solar, without that 30% tax incentive. So I think we get to a point where this makes sense again for people. And for a lot of people, it makes sense today. Just depends on what market they're in, depends on what they're paying for power. So I think people should still continue to look at solar as an option, and not just because it's good for the planet, which it is, but because it's good for their wallets as well. So I hope we continue to see that. I think we will. Really enjoyed talking with you today, though. And again, this is a thing where the bank, we've seen a lot of growth and a lot of demand increase over the last few months. We're grateful for that. We love our customers. We love our installer partners that we have, but this is not the way we wanted to see it happen. And we are very hopeful that there's, a change in legislation in the future that gets us back on track to policy that is truly supportive of a broader energy policy that includes solar.
Well, thank you for that, Chris. They call it the solar coaster. There never seems to be a
right.
dull moment here in the industry,
sure.
but we do always seem to find a way to readjust our footing and get back on track. So I'm sure that will happen this time as well. Folks, again, this has been a chat with Chris Cucci. He's the Executive Vice President and Chief Strategy Officer down at Climate First Bank. That's one of the lenders that we've talked a lot about on the channel this year. Of course, I've said if you can pay cash for your system, go ahead and do it. But if you are going to finance it, better to just use a traditional FDIC insured lender where you're going to have full transparency, full disclosure on everything. And of course, you can avoid those dealer fees. But folks, that pretty much does it for today's interview. I thank you all for spending some more time on the Solar Surge channel. And as always, I'm Joe Ordia here, encouraging you to get prepared and be empowered. Thanks for watching, and we'll see you on the next episode.